Stop what you're doing. Silver just went from $92 to $81, and it didn't fall like a feather. It fell like a trap door opening under a crowded theater. Today is Thursday, January 22nd, 2026, and what you just witnessed was not normal volatility. This was a liquidation event, a mechanical snap, right on the seam between London and New York. So in this video, I'm going to walk you through the plumbing. 1. Why the crash ignited exactly as London closed and New York opened. 2. The CME margin switch that forced desks to puke positions. 3. The London to NY arbitrage that finally broke. And 4. The exact levels that decide whether this is the end or just the start. And yes, this is education, not financial advice. I'm giving you a framework, not a trade. This wasn't one long, slow bleed. It was 2 waves. Wave 1 started as London was heading into the close. That's when the market is most sensitive, because liquidity thins. Dealers widen spreads. Market makers step back. And any big order starts to move the tape like a wrecking ball. Wave 2 hit the moment New York opened. That's when the COMEX futures engine wakes up. That's when the leveraged positions get marked. That's when margin math turns from theory into a demand letter. Your last hour snapshot sits right in that second wave, 7 p.m. to 8 p.m. IST, which is 8:30 to 9:30 a.m. in New York. And in that window, the tape looked like a heart monitor. Current spot, about $83.24, trying to hold the 52-week support line. Session high, 94.28. Session low, 81.10. So when you ask, how did we fall 11% in 4 hours? The answer is the worst possible overlap, at the worst possible moment, with the most leverage in the room. Now watch what that implies. If you were a London physical desk, you were quoting premium. If you were a New York futures desk, you were carrying leverage. If you were a spread trader, you were doing both. And if you were wrong on timing by even 30 minutes, you weren't down a little. You were margin called into the floor. That's the setup. Now here's the trigger. The margin acts. Most people hear margin hike and shrug. Let me translate it into real life. A futures contract is leverage. You control 5,000 ounces of silver with a fraction of the cash. That leverage is the oxygen of the speculator. Take away oxygen, and people don't argue. They gasp. The CME shifted silver margins from a fixed dollar amount to a percentage-based requirement, meaning as the price climbs, the collateral climbs automatically. And at these prices, that is a guillotine. Do the math with me. At $96, one contract's notional value is 5,000 ounces x $96. $480,000. Now apply a 9% maintenance requirement, 0.09 x $480,000, $40,200. So when people say around 40 grand per contract, that's not drama. That's the bill. And here's the part retail doesn't understand. Margin isn't just how much it costs to open a trade. There's initial margin, and there's maintenance margin, and there's the daily mark-to-market that punishes you as price moves. When the required margin jumps overnight, your broker doesn't politely ask your permission. The system checks your account. If you don't meet the new requirement, it reduces risk. How? It sells. That's why it felt like there were no buyers. Because the market wasn't discovering a fair price, it was running an emergency evacuation. In a normal sell-off, humans stagger out the door. In a liquidation, bots shove. Risk engines see a threshold break. They don't debate narratives. They flatten exposure. So the order flow becomes one-sided. Auto-liquidate orders, stop-loss cascades, hedge unwinds, and programmatic sell to reduce VAR. And that creates the vacuum. Price drops, which triggers more stops, which triggers more selling, which triggers more margin pressure. A feedback loop. A self-licking ice cream cone from hell. That's the mechanical core of a flash crash. The London to knee snap. Now here's the twist. For the last 24 hours, London spot was acting stronger. We had a premium, reportedly around 115 over COMEX. A simple story on the surface. Physical vaults tight in London, paper pricing looser in New York, and traders smell free money. So they try to do what they always do. Buy where it's cheap, sell where it's rich, move metal, close the spread, collect the difference. But the spread trade only works when you can actually move the metal, and that's where the squeeze becomes real. Picture a line of trucks on a bridge. London is on one side, paying more. New York is on the other, paying less. Everyone wants to cross the bridge at the same time. Now add a storm. New York starts dumping paper, the bridge shakes, and suddenly the trucks stop moving. Not because the profit disappeared, but because the pathway couldn't handle the flow. So the bridge breaks. Normally, when New York gets ugly, London can stay premium because physical is physical. Different constraints, different players. But this time, the paper selling in New York became so heavy, the physical market couldn't absorb it fast enough. The spread didn't compress nicely. It snapped. Think of it like a tow rope. London is the truck. New York is the trailer. For a while, the rope is tight, pulling them together. Then the trailer starts sliding, faster and faster. At some point, the rope doesn't stretch anymore. It breaks. When that break happens, you don't just get New York down. You get London forced to reprice to match the liquidation zone. Because if paper price is collapsing, anyone quoting high physical is suddenly exposed. They hedge with futures. Futures are melting. They cut bids. Physical follows. That's the snap. The link between paper and physical didn't disconnect gently. It broke violently, and London got dragged into the same crash. The paper game hit a wall. Now let's talk about the thing nobody wants on the thumbnail, the paper to physical ratio. Before the drop, desks were whispering numbers like 356 to 1, meaning for every ounce of deliverable metal, there were hundreds of ounces of paper claims floating around. Whether that exact number is 320, 350, or 400 isn't the point. The point is the shape of the system. Too many claims chasing too little reality. And when price is rising, that system can pretend forever, because confidence is the glue. But when price spikes, margins rise, and liquidity vanishes, confidence cracks. The exchange doesn't want a delivery problem at $95, so it raises the cost of leverage. It forces weak hands out. It reduces open interest. It protects the clearinghouse. That's not a conspiracy. That's how the machine is designed. The ETF wash. While this is happening, watch what the pros use as the escape hatch. Not coins, not bars, not a phone call to a dealer. Liquid ETFs, SLV, SIVR, massive volume. We're talking 140 million shares plus kind of days. Why? Because in the middle of a flash crash, the only thing that still trades like water is the most liquid wrapper. So smart money can flatten exposure fast. Meanwhile, the physical buyer at home is sitting there, watching a screen thinking, my dealer won't answer. That's the split. Paper has instant exits. Physical has friction. The retail trap. Now I need you to hear this part clearly. The move from $92 to $81 is not just price discovery. It is a flush, a cleansing, a shakeout. Latecomers bought the breakout above $90. They chased the candle. They were told the moon was guaranteed. Then the market did what it always does in a leveraged asset. It punished the maximum number of people in the minimum amount of time. When price free falls, your brain screams, get out. You sell at the worst possible spot. Then the market stabilizes, and you're left holding regret instead of silver. That's the trap, and the trap is psychological. So what matters now is not your opinion, it's the map. Here are the levels that define the battlefield. $95.87, the 2026 all-time high. Rejected. That's the dream ceiling. $88, the old iron support. Broken. Now it becomes resistance. A ceiling you have to earn back. $84.10, the 20-day moving average. Critical. We are fighting for this level right now. You'll see it in the tape. Sharp bounces, quick slams, 81.0, the floor. If $81 fails cleanly, the next magnet is the value zone around $74. And when I say magnet, I mean that's where bids can reappear because value investors start to step in and shorts start to take profit. But don't confuse a bounce with a recovery. In liquidation events, dead cat bounces are common. The question is, does the market rebuild structure? 3 scenarios from here. Scenario 1, the floor holds. We base above $81, reclaim $84.10, and grind toward $88. That would mean the liquidation wave is mostly done. Scenario 2, the floor breaks. We lose $81 on a clean close, and the market searches for $74. That would mean forced selling is still active, and the tape is still controlled by risk engines, not buyers. Scenario 3, the split returns. Paper bounces, physical stays tight, premiums stay stubborn. That would tell you the squeeze didn't end. It just moved from the screen into the supply chain. What you watch next? If you want a sane checklist, here it is. 1. Does $84.10 hold on an hourly close? Not a wick. A close. 2. Do we reclaim $88 with volume? If not, rallies are suspect. 3. Do ETFs keep printing monster volume? If volume stays extreme, the unwind may not be done. 4. Do premiums in the physical market stay elevated? If physical refuses to follow paper down, that tells you the squeeze isn't over. It's just changing form. 5. Watch the spread. If London premium returns quickly, the snap was a temporary panic. If it doesn't, the system is repricing. And above all, watch for policy and exchange actions. When exchanges change rules, they are telling you where the stress lives. The news layer. Nobody can ignore. Even mechanics need a spark. And today the spark was sentiment. When headlines shift from escalation to de-escalation, risk premium evaporates. Money rotates out of defense and back into risk. That doesn't cause an 11% crash by itself, but it removes the bidders who would normally catch the fall. So you had the worst combo, a rule change that forces selling, plus a mood change that deletes buying. That's how you get a slide that feels like gravity doubled. What this means if you hold physical. If you're a short-term trader, the tape is the boss. Levels matter, liquidity matters, stops matter. If you're a long-term stacker, your enemy is panic, because the paper price can whipsaw while the real-world availability can stay tight. So the move here is not bravado, it's process. Know your time frame, know your position size, and don't confuse a forced liquidation candle with the end of the story. The big takeaway, silver didn't randomly fall, it was squeezed, and then it snapped. The squeeze was the premium. The snap was the margin. The crash was forced liquidation. And the lesson is brutal but simple. In a leveraged market, the price is not set by who is right. It is set by who is forced. So don't let one candle rewrite your identity. Zoom out, respect the mechanics, and treat this market like what it is right now. A battlefield with moving walls. If you want me to do a follow-up when New York closes and map the next 24 hours with the same levels, comment one word, snap. One last thing to watch tonight. When New York approaches the close, look for the tell. Does selling slow or does it accelerate? If the close print's near the lows, that's still forced. If the close print's above $84 with calmer volume, that's stabilization. Either way, respect the tape. And if $81 breaks after hours, don't be shocked by $74. Tonight, stay sharp.